Hey there and welcome to Real Investment News. I'm Mike O'Neill. Well, so much for the markets mellowing out. After a nice start, things have started to kind of go downhill. The S&P is down 24 points, the NASDAQ is down 100, the Dow is down about 380 points. The only thing that seems to be climbing today is volatility. Right now it's up 28.24. You can see the spike that happened just this morning. We're going to be monitoring this throughout the day, but I wanted to talk to you about something else. Now, when President Trump signed that tax reform bill at the end of December, companies rushed to announce that they were increasing wages and giving employees big bonuses, usually of up to about $1,000 each, because of that big cut to the corporate tax rate. The folks at Americans for Tax Reform have been keeping a running list so far. Right now, they say there are 335 companies that have either increased their bonuses, raises, their donations through 401k plans. That is impressive. But what about the rest of the money? Now, we told you last week how Walmart's bonuses and increases of its starting wage to $11 an hour would cost the company $700 million. But after that announcement, Walmart began closing stores and cutting back on staffing. They were a little more subtle about that, and they didn't make a big deal about their $4 billion stock buyback plan. In fact, company buybacks have nearly doubled from last year. From January until now, 61 companies have announced $88.6 billion worth of stock buybacks. Compare that to the 58 companies who bought back $40.3 billion at this time last year. And when you look back to the start of the bull market in 2009, you can see the number has been climbing with the exception of 2016. Now, this is when companies actually took advantage of a market correction and then bought back $104 billion worth of stocks. But what does this all mean? Well, it means simply that companies are using the tax cuts to boost their EPS numbers, investors are making more money, and the workers, not really a surprise when you consider this moment. From last November, it was at a Washington Post CEO Council. Do you remember this? Some of the nation's top CEOs were asked to raise their hands if they planned to use the cuts to increase their company's capital investments. And when you look, very few of them did. That was actually a big surprise to the president's top economic advisor. Now, when you actually take a look at the year-over-year wage growth of the bottom 80%, which is this orange line, versus those in the top 20%, which are these columns, yeah, the trend lines are pointing out what you might have already guessed. Those at the top are growing much faster, while everyone else, they're dropping. Well, that's it for now. Thank you so very much for watching. Please remember to follow us on Facebook and Twitter and YouTube. Check out our past reports on realinvestmentnews.com. I'm Mike O'Neill, and we'll see you again in a couple of hours.